Joining me now to discuss the outlook for the US, the world's largest economy, ahead of a key policy meeting next week by the Federal Reserve, is senior economist Gregory from BMO Capital Markets in Toronto. Michael, first of all, payroll numbers have been choppy throughout the year. We've just had the release of both the ADP employment change and initial jobless claims, which came out at 365,000. How does this fit in line with your expectations for Friday's non-farm payrolls data? Are you hoping the data will help clarify any recent trends?
Well, the indicators we've gotten just recently suggest that maybe conditions could be improving ever so slightly. I mean, as it stands right now, the consensus call is looking for a little bit of a cooling in the job growth we saw in July. We're of that same view, looking for slightly less as well, about 120,000. And I think the key thing right now is that what is that underlying trend? Is it improving month to month? These things could be quite volatile, but I do think is improving slightly, but the important thing, still not enough yet in order to convincingly show that the unemployment rate first has stabilized, let alone has started to drift down.
But in terms of the Federal Reserve Chairman Ben Bernanke's speech last Friday in Jackson Hole, do you think the speech provided much forward guidance and direction as to what we should expect to get from the central bank next week?
I think it kind of corroborated what the minutes from the FOMC meeting indicated the week before, that firstly the Fed is a lot closer to easing than what most people thought. The criteria for them to stop easing is signs of a substantial and sustainable growth. Those are the precise words they use, and we're clearly not there now. It doesn't look like we're sustainable. It's the job growth that will lead to the sustainability, and substantial means you get enough job growth to make a dent in the unemployment rate, and both of those criteria aren't met. So, it does appear the Fed is going to ease. Mr. Bernanke laid out the two options that were 1 and 2 on the list of the FOMC. The first one being change in the forward-looking language, basically saying they'll keep their rates low not till the end of 2014, but probably well into 2015. That seems to be literally baked in the cake for next week. QE3, which is the next in the order of what they will do. I think the bar is high for that. I think you have to see much slower economic growth. We might be there in the months ahead, but right now it does look like they're going to ease by extending their forward-looking language.
The ISM manufacturing PMI fell slightly from 49.8 to 49.6, missing market estimates of 50, again though indicating contraction in the manufacturing sector. This is also the lowest reading for the PMI since July 2009. Should the US be braced for a deepening slowdown in orders and demand?
Well, it sure does seem. I mean, three sub-50 readings in the ISM is something comes on our radar screen. It's an alert of something is not working well. Clearly, the previously strong U.S. factory sector is starting to succumb to those global headwinds. There's no question about it now. Just domestic automobile activity and what kind of capital spending we're seeing domestically is not sufficient anymore to drive factory output in the U.S. and therefore a big chunk of the U.S. economy. Fortunately, it does seem that as the factory sector has started to ebb a bit, the housing sector finally looks like it's picking up the pace a bit. Whether or not it can take that growth baton and run with it, we'll have to see. But there's no question that that the riskiness of the U.S. economy now is probably higher. The growth projection is not much different. They're roughly around that kind of 2% range, give or take a little bit. But the riskiness is there because one thing we know about housing, while it has proved fickle in the past, and if it should fade because of job growth, because of credit issues, then all of a sudden the U.S. does not have much to stand on, and then that would be the occasion for much weaker growth outcomes.
Well, the housing market continues to show signs of being on the mend as activity seems to be picking up. What are the main downside risks now hampering the U.S. recovery going forward? Also, is shadow inventory not still a grave concern?
Well, yeah, I mean, the shadow inventory is a concern. I mean, there's two aspects to the shadow inventory. The first one is, homes that are currently in foreclosure proceedings that will eventually hit the market. Those seem to be, even including the homes currently available for sale, are basically in balance with the level of sales, which is why right now on the ground we're seeing stability in home prices. And that's the encouraging part about it. But we do know that there is this pipeline of potential homes to be foreclosed. There's a huge amount of mortgages mortgages that are underwater. There's also concerns about job growth, and so we are clearly not out of the woods yet in terms of recovery in housing. But where we are right now, assuming we don't get a huge surge in additional inventory, homes available for sale coming from increased foreclosure activity, I think that stability will stick. But again, we just don't know just what that pipeline is.
According to the annual Global Competitiveness Report published by the World Economic Forum, the United States has slipped further down a global ranking of the world's most competitive economies. Now, the US ranked first 4 years ago, and now it's in 7th place. With several factors pushing the US down the rankings, is America losing its competitive edge?
I mean, the U.S. obviously from this metric has lost a little bit of its competitive edge, but when you do look at sort of productivity trends, they have started to turn up again. U.S. businesses realizing that the top line sales growth and revenue growth looks quite lackluster, but want to maintain that decent earnings growth, that bottom line growth, are once again relying to their old trick of boosting capital spending, boosting productivity. So, I mean, that will help matters. It also helps matters that the U.S. dollar continues from a very longer-term perspective remains quite attractive, quite competitive. So I think longer term, I think that the U.S. stands to gain on its competitiveness internationally. I mean, right now cyclically it's probably weighing down a bit, but I do think that when the administration talks about doubling the share of U.S. exports in the years ahead, I think that's still a very doable outcome.
We're now exactly 2 months to date ahead of the November presidential elections. What kind of signals are we getting at the moment from the US elections? And looking at the political debates on policy surrounding the elections, how is all of this playing on market sentiment in the US?
There seems to be, divisions about, the path that fiscal policy should take going forward. But at the end of the day, and to quote, James Carville's famous saying, it's the economy, stupid. And when it comes down to it, the fortunes of the incumbents and the would-be, office holders will depend on just how the economy performs. I've said before, we're in a situation where on the fiscal cliff on the one hand and a credit rating downgrade on the other hand, the veritable rock and a hard place. How the U.S. policymakers, even the ones that are in office now or the ones that will be in office come next January, next February, how they will deal with that will ultimately be the major source of uncertainty for financial markets in the months ahead.
Michael Gregory, thank you very much for your comments on the US economy. Now, I'm afraid that's all we actually have time for at the moment on Dukascopy TV, but do join us again tomorrow. Goodbye for now.